In this week's market update, pressure builds ahead of the UK budget on Wednesday, gold hits a one-month high as equity worries mount up, and German political stalemate could bring the end of the Merkel era. Hogging the attention of UK investors this week will be Wednesday's budget, and there's a lot riding on it from the point of view of Chancellor Philip Hammond. He's being looked to satisfy a number of competing interests, including keeping the nation's finances on track, coming up with policies that can lure back lost voters and young people in particular, and of course, setting the economic ground for a successful Brexit. On the task of repairing Britain's balance sheet, the Chancellor has had some good news recently. The UK's borrowing this year has been below target, potentially allowing the Chancellor to fund some giveaways. The problem, though, is that other news on the UK economy has been less good. In particular, productivity remains below target and may cause overall growth estimates to be revised downwards on Wednesday. That could lower expected tax receipts and in turn make deficit targets harder to hit. There have been signs in the past few days that the government is trying to give itself some room on borrowing. It has announced an accounting change that removes housing association debt from the central figure, while Hammond may also let existing deficit targets slip. Watch the pound and gilt yields on Wednesday for any market reaction. If any wiggle room on borrowing is opened up, the Chancellor has no shortage of demands for the money. There's now great pressure to uncap pay rises in the public sector and to give help to young people somewhere or other. That could mean action on reducing the burden of student finance on graduates, but the firmest rumours ahead of Wednesday appear to be about the property market. Stamp duty for first-time buyers could be reduced, and there is likely to be attention paid to house building and the difficulty young people have getting on the housing ladder. That could mean a new target for the number of new homes being built, along with measures on planning and private house builders. But what now looks less likely is any state-driven house building programme, as has been called for. The Chancellor appears to be willing to pull other levers before he pulls that one. Other budget areas of concern to investors include the savings regime and the pension system in particular. As has become traditional ahead of the budget, tax relief on pensions is being seen as an area where the Chancellor can raise money. The current system is linked to income tax and is therefore more generous to higher earners. A change to the headline rate of tax relief would be the biggest change the Chancellor could make, but current thinking does not see that as very likely. More probable would be tinkering to the rules that govern pension saving, and the £40,000 a year limit on pension contributions is emerging as the likeliest contender. There is already a rule that reduces this limit for very high earners, and the Chancellor could move to expand who counts as a high earner for pensions. Perhaps the biggest potential outcome from the budget from a market point of view concerns the future of the Chancellor himself. If the budget is perceived as having gone badly, particularly if the Chancellor is forced into U-turns like the one from the spring budget on tax for the self-employed, then pressure is likely to build on Prime Minister Theresa May to replace him. That matters, of course, because in the ongoing wrangling over leaving the EU, the Chancellor is the most senior cabinet member pushing firmly for a softer Brexit. If he had to be replaced, it would probably be with someone more willing to countenance hard Brexit. And if the past year is anything to go by, that would likely hit the value of the pound and thereby raise the risk of inflation, something that has already pushed the Bank of England to raise interest rates. Last week, there was further evidence of faster rising prices when the official CPI rate of inflation was confirmed at 3%, well above the bank's target. Meanwhile, wage rises were confirmed as being stuck at 2.2%. The pound rose at the start of this week on reports that the UK would be willing to raise the offer of money to settle the bill for its exit from the EU. Markets think that makes progress on trade talks and a transitional deal more likely, lessening the chance of a cliff edge exit that would harm the economy. UK shares, both the FTSE 100 and all share indices, were marginally lower over last week. Elsewhere in markets, gold enjoyed a good week to reach a one-month high above $1,285 on Friday. The rise was helped by more nervousness about equity markets, with investors turning to the metal as a safe haven. In the US, current sentiment to equities appears hitched to the prospects for tax reform. President Trump is trying to push through reforms that would be broadly positive for corporates, and a bill is currently being debated by senators. Treasury Secretary Steve Mnuchin is positive that a deal can be signed by Christmas, although the details and the timings of any benefit to companies remains uncertain. US shares ended about level over the whole of last week, and trading this week will be foreshortened by an early close to markets on Friday for Thanksgiving. On Wednesday, the Fed will publish the minutes of its latest rate policy meeting. A rise in rates is expected in December, so markets will be looking out for anything to suggest the Fed will hold off. Then at the end of this week, it's Black Friday, when online retail sales will provide a snapshot of consumer sentiment on both sides of the Atlantic ahead of the crucial Christmas sales season. Meanwhile, in Europe, markets took the news that German coalition government talks have collapsed in their stride. The German DAX index recovered lost ground on Monday, and the Stoxx Europe 600 index also rose. No dramatic impact on the euro is expected from the deadlock. The collapse of talks leaves Germany's immediate political future in question. Chancellor Angela Merkel has been attempting to stitch together a coalition following the hung parliament that arose from elections last month. The talks collapsed on Sunday, and now there is the possibility of a minority government led by Mrs. Merkel, or of another general election that could see her ousted as the country's premier. Elsewhere, there was news on dividends at the start of this week, with a widely followed dividend report confirming that payouts are growing faster than at any point in the last 3 years. Highlights from the report include the fact that $4 in every 10 of dividends paid globally come from the US, as well as the fact that UK dividends have jumped 17.5% in the last year alone, albeit helped by sterling's devaluation. Finally, turning to oil, where prices jumped at the start of the week. Brent crude is now around $63 a barrel, and West Texas crude around $57, after news of a major pipeline leak that has seen nearly 800,000 litres of oil production lost. Also pushing up prices is news from OPEC, which has said it will reduce output. That's it for this week. Thanks for watching.